Hey folks, welcome to Business Foundations. Again, my name is Drew Aldridge, President of Mobilization Funding, and so far we've talked about bank lines of credit and asset-based loans. Today we're going to talk a little bit about factoring facilities. So at a high level, factoring facilities do this. In construction, cash flow timing is everything. You start the work, you submit your invoice, you have to wait 30, 45, 75, 90 days to collect that cash. And what a factor does is they buy your invoice. You submit an invoice to your customer, they buy that invoice, and then they will give you the cash equal to the amount of that invoice with an advance rate applied to it so that it can expedite that cash conversion cycle, that cash conversion on the back end. Now, I'm not talking about on the front end during work in progress. I'm talking about the back end once you have completed that work. But they will provide cash to you in advance of you actually receiving that cash from your general contractor, just expediting those payment terms, getting rid of those payment terms for you, for a lack of a better term. So how does a factoring facility actually work in practice, right? You're on a job. You have a GC that you've worked with for a long time. It's a quality GC. They pay on time. You worked with them on a number of projects. However, their payment terms are 60 days. So what happens is you work for 30 days. And let's say you submit your invoice to your customer, the general contractor, on the 25th of every single month. And then it takes them 5 days to approve that invoice. And then there's a signed invoice. What happens then is the factor will then purchase that invoice. So there is a sale, there's a transfer of ownership of that particular invoice. That's very different than an asset-based loan, to where they're advancing you based on a borrowing base associated, like we talked last time, with your accounts receivable balances, the eligibility of those accounts receivable. Maybe you have some inventory. But in factoring, they are actually purchasing that invoice. So they will, let's say it's $1 million invoice, and they have an advance rate of 80%, for example. They'll advance you $800,000. Now, you can use that $800,000 on the job for the next months of work for materials, payroll, equipment rental, or you can use that cash for your overhead and operating expenses. It really doesn't matter. But the takeaway here is, number one, they give you an advance rate, just like the asset-based lending facility, or just like maybe a more traditional, a little bit more graduated line of credit with the bank. But the number two thing to think about here is they are purchasing that invoice. So what happens? Your general contractor is notified that you're working with a financing solution like a factor. It's not really a loan, it's a transfer of ownership of that invoice. So in that scenario, your GC actually pays the factor. They don't pay you. They pay directly to the factor because, again, they are purchasing that invoice. There's a transfer of ownership. You are selling that invoice at an 80% advance rate in exchange to expedite your cash flow on that particular project. So what a factor will typically do is there will be an agreement between the factor and the general contractor and you, saying that that particular general contractor will pay that factor, the organization that purchased your invoice, because now they own the rights to that future cash flow. And then when they actually get paid, they will then charge you a fee. And then let's say you got $800,000. The fee, let's say, is $100,000. You will get the remainder of that $1 million minus the amount they advance, minus the fee, and that's what gets remitted back to your operating account. So it's a really, really useful tool for high growth contractors who may not quite be ready to work with a bank, right? Because for a number of reasons. A, maybe you went through a few years of losses, because factors really do not focus as much on profitability as they do on the quality of the invoice, right? And you have a credit grade company who you're working with as a specialty contractor, and maybe you work direct. Maybe you don't work through a GC. Maybe you work direct with a Walmart or an Amazon, like a really, really strong company. A factor is going to look at those receivables as being very, very strong, right? So they might give a little bit higher of an advance rate on that. But yet again, they are purchasing the future cash conversion scenario. So purchasing the invoice, the owner or the GC pays them because they now own it. And they'll submit a notice of assignment, which is essentially a notification to your customer, the general contractor, the owner of the project, saying they are required to assign those receivables and that cash, that payment, to the factor. So some specialty contractors don't mind that. I mean, but a lot of specialty contractors would mind going to their general contractor and take issue with going to their contractor and say, hey, I'm doing this work. I'm going to submit an invoice, and then I'm selling that invoice, the right to that future payment, to a third party. Now, a lot of general contractors understand this is a necessary condition, right, for the industry. We talked about the structure of the industry, and the payment cycles make it very, very tough for commercial subcontractors to operate because essentially they're acting as a bank, right? But a factor comes in and helps them complete the job, helps them operate their company through expediting that cash flow cycle. But a lot of general contractors have issue with a factor taking ownership of those receivables because there could be all sorts of legal considerations, or an oh no scenario. There's that third party, there's that like kind of extra cook in the kitchen. But at the end of the day, this is an extremely effective tool for construction contractors. Now, here's another thing to consider. A lot of factors will not factor bonded jobs because the sureties have first position on the receivables anyway. So they are going to be first position on those receivables because they own the receivables that they factor, right? And most requirements for a lot of factors is that they factor all the receivables for the company. Now, in construction, it can be a little bit different. Some factors will cherry pick the certain projects that they actually want to factor because they like those payers a little bit better, because their underwriting, their risk consideration is associated, A, can you finish the work? But mostly, more so than that, is the person paying the bill, right? Is your customer a strong customer? Do they pay? Do they pay on time? This can get a little dangerous. If they start not paying on time, then the advance rates might decline. Maybe your factor decides not to factor future receivables, but your business model and your cash flow timing and framework and roadmap depend on that partnership with the factor. Lastly, what is the true cost of a factor? Now, that depends on what factor you're working with, what kinds of invoices that they plan to factor or purchase, put another way. It really depends, but it could be 2 to 3% for every 30 days that your cash is outstanding. For example, if you submit your invoice, they purchase that invoice, you get paid back in 30 days, it could be 1.5 to 3%. Now, if your payment terms are 60 days, that can add up. On an annualized basis, that really can add up if you multiply, call it 2% every 30 days times 12, that ends up being 24%. But you're also not considering the fact that there are wire fees. You're also not considering the fact that there is a scenario where they hold back funds in the form of a reserve, which the opportunity costs of not being able to deploy that extra cash into your business or reinvest in your business or buy materials, opportunity costs of that can be high. So what I've seen is subcontractors, or companies in general for that matter, tend to underestimate the true cost of working with a factor. Now, they are a little easier to probably get approved by than an asset-based lending company. Now, I've kind of bank line of credit, pretty hard to get approved. ABL, a little less hard, but still pretty hard. Factor, remember, they're looking at the quality and the invoices and general sort of operational components of the company, and can you complete the work. But in closing, and I'll kind of review, a bank line of credit is really used for those typical cyclical times during the year to just bridge a short gap, but it shouldn't be used to draw up on that line in perpetuity and have that outstanding and not recycle those dollars. In ABL, sort of the same way, but it's less on profitability, which is why low margin businesses can work with ABLs. It's really predicated on the health and solid foundation you have with regard to your asset base. And then factors, they really judge the payer, right? that when they're buying an invoice, do they think they can reasonably get paid based on payment history, based on quality of payer, like they could be Walmart or Amazon? And have they created a system with your company to where there's a predictable repayment structure so that you can continue to use the factors? So, in closing, factors are incredibly, incredibly useful for high growth contracting companies. But when you sit with bonded jobs, or maybe you're working with the government, right? They begin to be a little bit more of a nuisance, or maybe unable to use them at all in those particular scenarios. And again, the last thing is it is a transfer of ownership. They are buying your future cash flow in a sense. So thank you for joining us today. Hopefully that was helpful for you to kind of understand how a factor works. Please reach out to me, ask any questions. I can get a little deeper. Happy to jump on the phone. Thanks for joining Business Foundations Factoring Edition. Thank you.